summertime.
It's funny you mention that because most allocators want to hear or have it offered to them the level of transparency, better fees, right? The deep dive. But it sounds like you're doing it slightly different where you're almost courting the manager.
I would say we're courting the managers that we want to, because, let's use Japan for a second.
Okay.
Because I think it's also a great opportunity. So let's use Japan for a second. Because the Japanese market, outside of the last 2-3 years, on and off for the last 40 years, has been relatively dead. The quality of the managers or the new talent of emerging managers is very, very small in Japan.
Yeah.
So when we are finding a manager that we think is highly talented, highly motivated, and the right manager for the opportunities that we want to capture, I have to court them, right? I'll give you an example with the manager that we recently invested. He wanted to raise an additional $30 million of capital, and he'd be happy with for the next 2 or 3 years. So even though we didn't know him, but we spent enough time with him, I said, I'll make you a deal. I'll give you everything you wanted in terms of capital. You close your strategy for the next 2 or 3 years. You give me better fees, but this way you don't have to do any more marketing. He goes, done. Okay. I would have given him a quarter of that capital and then slowly build him over the next 2, 3, 4 quarters. But because of that arrangement, said, no problem. I trust you enough after the first week. I'll give you all that capital and let's close you down. So in certain markets, you unfortunately have to court the best managers because it's just very difficult. I'll tell you, just going back to Japan, we are now in a position where we're actually, and I think it's the only market we've done this, maybe a few times in the US, but very, very small. But in Japan, where we actually are educating and cultivating what we think are up and coming managers who want to learn more from how the US or European investors who've been investing for many, many years do stuff, because their market is still relatively new in terms of like coming out of a multi-decade deflation, etc., where we are acting almost as consultants of how should you construct a portfolio? How should you look at stuff? How should you structure? And we are a bit more, I would say, active there, where we get preferential treatment and transparency. And I would say with all of our managers, we're very friendly with them to the point where it's more of a familial relationship than an LP, GP, etc. Like we go see companies with them. But Alvin, you have to invest the time.
Yeah.
If you're an institutional investor whose board or family doesn't allow you to invest the time on the ground, like when we invest with a manager, first thing our founder says, did you go and see the manager? Did you go and meet them? Did you go and break bread with them? How long did you spend there? Like I have a lot of friends and colleagues in this space that their families or boards or endowments don't let them spend more than a couple of hours. Oh, it's too far. I don't want you to travel to China.
Yeah.
What do you like? Why do you need to spend $10,000 on a due diligence trip? And when I think that, if you're going to invest tens of millions, what does $10,000 mean actually in the grand scheme of things into nothing? It really is like sometimes I find the answers I get from some of my peers about the due diligence budget that they have for global travel due diligence relative to the investment capital is so small that it just doesn't make sense.
It doesn't make sense. I completely agree. And I think the template for the approach for allocators, it kind of bakes in an entitlement for most allocators, especially if they're a size. And I get it though, right? It's grinding because all of us, we're looking at 450 or more managers a year.
Easily.
Right? And so I get it. It can grind on you. And for a lot of the gatekeeper teams, they're just doing their job. So I'm wondering out loud whether because you're a founder, you got skin in the game, maybe it makes that difference. Whereas the larger allocators where they may or may not have as much skin in the game, that could potentially be a reason in terms of alignment of interest.
So I'll switch it up a little bit. So we all know Mohamed El-Arian. And I read a book of his 10, 12 years ago. And in that book had a lot of interesting stuff. But one thing I loved in that book that we do, he had a 4-quadrant square where he breaks down the square in the following into 4 categories: important and urgent, important but not urgent, urgent but not important, not urgent and not important. And unfortunately, as human beings, what he's shown that the big tasks, the more complicated money-making, long thematic tasks are in urgent and important. But these are multi-week, multi-month type tasks. The unimportant and unurgent are small tasks, checking emails, responding to somebody, etc. But as human beings, we spend most of our time on the unimportant and unurgent categories and not on this one. So going back to how I think we invest versus other investors, if because you said like there's so many managers, 450, etc., that some of us see, some of us even see multiple of that. If institutions broke down their universe by what do I think is important over the next 12, 24, 36 months, and just allocate on managers within that thing. This is what we do. So when we get the 450 we get a year or 1,000,
Yeah.
80% of it we push by the wayside, because if it's not in the urgent and important, if it's not in what we think we need to invest in over the next 12 to 36 months, we don't waste our time. And I think institutional endowments should probably refocus their efforts on, hey, where do we want to put our capital? And that's where we should focus all of our effort. Because otherwise, again, to your point, you get bombarded by all these
Yeah.
other funds, all these other things that might be irrelevant for the next 2 or 3 years.
The hardest part is saying no.
Of course.
And I just want to go back to this point because you're kind of describing a really old school hands-on way of doing due diligence that aren't too many teams that are committed to this approach to not just being on the ground, but going so far as to break bread it's a lot, right? Especially even for managers that you like, those that have capacity, fit all the boxes, ODD, etc. But even on the point of due diligence, how do you approach due diligence, especially from like an ODD perspective, when a lot of these emerging managers don't have the full setup? They don't have all the institutional box checked off. They might not even have an independent director on the board, for example, right? Like, is there something that you're willing to either work with or you're willing to, I wouldn't say turn a blind eye and be like, this is a risk that I'm willing to take that maybe some managers might be overemphasizing and it might be getting in the way, or even from the allocator side, maybe they're letting certain aspects of due diligence get in the way of a great manager?
So good question. I would just say one other thing with the managers with breaking bread is in our notes. If you ever read our notes about managers or meetings we do with anybody, a couple of things you're going to find. How much capital they have in the fund? Do they have capital outside the fund and in what investments? How many kids they have? They're married, not married, ages of kids. I think you have to really understand all of that stuff. So you'll really see that. And I push my analysts to do the same thing of trying to get that picture, right? Because a manager who's married or not married, having kids or not having kids, might just have a different risk profile. So now, with the operational due diligence, I'll break that into 2 categories. And the really, really emerging, like the guy that I told you that, or the portfolio manager with $100,000. When people are that small, we put that into our own prime brokerage. So whether it might be Interactive, Morgan Stanley, UBS, whatever, any of the big PBs, we basically put all the bells and whistles on that manager. He could actively trade, buy and sell in that PB, our account, no withdrawals, etc. So that's the cleanest and easiest way to control a lot of these emerging managers. And in addition, what we do, just in case that manager violates his own risk controls, we have that prime brokerage already in bed into the execution management, etc. Risk protection, that if the manager violated, let's say if you get in bigger than a 5% position of short selling or whatever he does, it automatically flags it. And the PB, without even calling us, can eliminate that position or shut him down. So I would say that's probably about half our portfolio. The other half is, I would say, still emerging managers, but a bit more established now, maybe a couple of years of experience, etc. Generally, they're at some of the better PBs, right? Like the big guys, etc. But even if you are the smaller PB, so what we do there from an ODD is we get direct feeds on a daily or weekly basis directly from the PB, as if we're an account holder of the manager, right? So we can see the assets are there. We could see all the trading. We have direct contact with the auditors or the administrators. We try to do as much from a ODD as almost like be part of the firm to get that feed to make sure that everything is okay. So that's really, I would say, the two buckets, more in the emerging and more in the less emerging. But none of that, Alvin, supersedes that we spend with that manager and really getting to know them. Because you and I have seen examples where it's the best ODD, the best of everything, but yet you sit in front of that PM and you know that you can't give him capital. You just know. Amazing returns, amazing everything. Something tells you that you just can trust them. And we go with that. And every time, we're only human, every time we violated that, we end up being, unhappy, right? So we're trying to just do that. It's as simple as not falling for stuff. It's don't be greedy. Once you're greedy, oh, but they've got good returns, but yeah, their ODD is just okay. No, you got to have all those bells and whistles.
When you look at the state of, I find your office is probably the perfect representation of an institutionalized family office. And like every day I have new teams walking into my shop who are new family offices, first generation, or becoming very institutional very quickly, right? Before it was, you'd have to be like 2 or 3 generations down, and then you have like a whole investment team, and then you bring the Bloombergs in, and there's a risk management. Your team actually has the SMAs and the risk management framework built in as well, which is one of the high barriers of entry for other family offices, because you have to build those pipes and you have to build the risk and have an understanding and a relationship with the brokers. When you look at kind of how your firm has evolved and maybe in how your peers are growing as well, do you see family offices becoming kind of like institutions on their own because they're so active now and they're so involved directly with the moneymakers that it kind of sidesteps the whole private banking relationship, the whole prime relationship entirely? And I wouldn't say negates it. There's always going to be a space for them, but where do you see this path going and what it means for you and your peers?
So I would say two things. A lot of families, and you probably know more than I do, but a lot of families, in my opinion, are way, way too diversified. So when you're way, way too diversified and you're trying to establish PB relationships or SMAs, etc., if let's say you're running $1 billion, but you have 50 or 100 managers or 100 line items, each of these line items is less material to a counterparty. So it makes your job just much more difficult. Because we are concentrated, every one of our line items is much more important to a PB. So I can come to a PB and say, hey, I want to put, tens of millions of dollars with this manager. Can I get access? So it's much, much easier. So when I look at the other families, I think every family is different. Like they're structured differently. I know some families who don't want any SMAs because then they have transparency, and with transparency creates responsibility, because if something blows up or if something goes awry, they're responsible. I mean, I'll never forget, I had a discussion with one of the largest pension plans in the country for one of the school systems, and I go, the guy, with your money, you're basically able to price everything at whatever price you want, negotiate whatever terms anything you want, these guys have to give you because, I mean, you're 50% of their capital. He goes, yeah, but
Exactly.
the problem is if I ask for transparency, then my board holds me accountable for when things go bad. And I don't want to do that. I'm only getting a salary, right? So you have agent principal issues here, etc.
Yeah.
So I think family structure, how you get compensated, the kind of transparency you want, how diversified or undiversified you are, all of that, just creates this too many things. And,
Their signal to noise ratio gets broken up too far, right?
and also a lot of these families are so diversified. Like we're very different in that if you look at our portfolio, 4 themes in the portfolio at any point in time over our history account for about 80% of our capital. Think about it, 4 bets account for 80% of our capital. Now, each bet might have 1 manager, might have 5 managers, etc., but they're basically highly correlated, highly directional, thematic bets. And that's how we build a portfolio versus a lot of other families are so, and it's so interesting because when I talk to some of my peers who I value very highly, some are actually even 1,000 times more than I am. And my guys, why don't you follow our model? Because Isaac, I wish, but our founders don't want to. Like, I wish you could do what you do. It's so much more exciting. It's so much more
Yeah.
rewarding,
Yeah.
but they just don't. I have one friend who all he's allowed to do is low net equity long short US. And there are
Brutal.
multiples of our capital base. Alvin, there are multiples of our capital base. And I go, why?
Yeah. Their
Because that's
objective is
what you want.
preservation. Yeah, they're really just literally preserving the capital, regardless of what the hurdle rate is.
That's what my founder wants. They go to me, but like,
Right.
explain to him, like, I think he just doesn't want to listen.
So
And
you
maybe
mentioned
I have
4
no
themes.
upside, right? Like he goes, like, maybe I've got no upside. So like, what do I have like to shake the tree? I mean, this, I'll do what, what I'm doing and that's it.
To your point earlier, it's the agency principle issue, right? Right. And so it's essentially a systemic flaw. It's a flaw in the system that's holding back these allocators from making more money. They just
And
have to do their
everything
jobs.
right. And now that I've actually been very transparent with our model to all of my fans, to all of my peers, compensation was, etc. And everybody loves it, but they haven't found like the institutions they work for just don't want to apply it. And even if they educate them that from a performance perspective, they'll do better because they're eliminating more of the agency issues. They just don't want to. It's almost like I was telling somebody at a conference 3 or 4 years ago. It was a 40-person CIO only conference of foundations, endowments, and a handful of family office. And I asked one of the lead CIOs, who was very well respected with his peers. I said, hey, we had David Swenson came up with the model 20, 30 years ago that all of the guys follow. One of
That's
you,
right.
I said, one of you should come up with a new model.
Yeah.
And one of them, actually, I love this guy. One of the basically said, Isaac, I'm going to come up with a new model, and I have one, but only if all my peers agree to follow me. And all the peers said, no, because I might lose my job.
Exactly.
But I said,
Career
one
risk
of
is
them
too
should do
high.
it. I said, one of these guys, he goes, Isaac, we have no upside. Like, why should we do it? But David Swenson did it. I don't know, his full history, etc. But like, listen, he was the lead. He created like the endowment style model, etc. And everybody followed. I think we need a new model. I think one of the CIOs, whether it's from the